Donald Trump, along with his sons Donald Trump Jr. and Eric Trump and the Trump Organization, has filed a federal lawsuit against the IRS and the U.S. Treasury Department, seeking at least $10 billion in damages. The lawsuit alleges that the agencies failed to protect the Trump's confidential tax returns, which were leaked to news outlets such as the New York Times and ProPublica in 2019 to 2020, causing reputational and financial harm as well as public embarrassment. The leaks originated from a former IRS contractor, Charles Edward Littlejohn, who pleaded guilty to unauthorized disclosure of tax return information. While the lawsuit is already active, whether Trump will succeed in recovering the $10 billion remains uncertain, as lawsuits against federal agencies face legal hurdles like sovereign immunity and jurisdictional issues. Should the United States taxpayers pay for the crime of Charles Edward Littlejohn? The last 6 U.S. presidents had the following practices regarding tax returns: George H.W. Bush, Bill Clinton, George W. Bush, Barack Obama, and Joe Biden all publicly released multiple years of their tax returns while in office. Donald Trump, however, broke this long-standing tradition by refusing to release his tax returns during his presidency, making him the only recent president not to disclose them. When portions of Donald Trump's tax information were exposed, they revealed several controversial financial details. He paid only $750 in federal income taxes in 2016 and 2017, and in some years paid nothing at all, which, while legal, was unusual for someone of his wealth and sparked debate over tax loopholes and fairness. Over decades, he reported more than $1 billion in business losses, which allowed him to offset income and reduce taxes, though some experts questioned whether these losses were entirely legitimate or used aggressively to avoid taxes. Trump also owed hundreds of millions in loans to banks and other entities, some due while he was president, raising concerns about potential conflicts of interest or foreign influence. Additionally, he took extensive deductions for personal items, including airplanes, residences, and even $70,000 for hairstyling for TV appearances, which, though possibly legal, were viewed as aggressive tax strategies for personal benefit. Some of these financial moves could fall into legal gray areas subject to IRS review, such as depreciation claims and business loss reporting, though no illegal activity was formally charged.